All right, so this is our Taxes 101 webinar. So thank you again for joining us. And Annie, take it away.
All right. So today we're going to be looking at a few different things. So our learning objectives or learning outcomes for the day. We hope that you will understand the different kinds of taxes that there are, learn what tax money is used for, understand why tax filing is important, increase your ability to read and understand tax documents, and also to utilize your W-4 to correct any employer tax withholding. And if you don't know what that means, it'll make more sense once we go over that part. So what are taxes? Taxes are required payments of money to governments, which then use the funds to provide public goods and services for the benefit of the community as a whole. So we'll talk a little bit more about what specifically different tax money is used for a little later on. Understanding taxes is an important part of managing your money, both now and in the future. So we're going to talk about a couple different types of taxes. So the first that we're going to talk about is income tax, which I think is what most people think of when they think of taxes. So income taxes are federal, state, and local taxes that may be collected on your earned and unearned income. So earned income means anything like salaries, wages, tips, commissions, anything that you work to earn. And unearned income is things like interest or dividends, if you have any investment income, things that you're not working a job or doing some kind of labor to do. So most of the federal government's revenue or the money it receives comes from income taxes. And the government may not collect income tax if your income is below a set amount. This also varies for the state and local income tax based on how much you make and which jurisdiction it's in, which state and which locality. Not all states and localities have income tax. And you can change the amount of income tax you owe by claiming tax deductions and tax credits on your tax return. So a tax deduction is an amount that reduces your income subject to tax. So this is often something like a personal or business expense that you are taking against your income. So let's say we'll use really small numbers as an example. If you have $100 of income and you spent $10 on something for work that was not reimbursed by your employer, a deduction would be taking that $10 off. So then you're only taxed for the $90 you earned after that deduction. A tax credit is a dollar for dollar reduction in the tax that you owe. So it can be deducted directly from the taxes you owe. And tax credits can also increase your tax refund. Some credits may result in a refund even if you didn't owe any tax to begin with. So income taxes are usually collected through withholding or deducting money from your paycheck. So employers will deduct that money right from your paycheck and send it to the government under your name or your social security number. But people who are self-employed, such as small business owners or rideshare drivers, also have to pay income taxes, but it's not withheld from their earnings. So if you're self-employed, then you have to pay these taxes on your own, and you should pay estimated taxes 4 times throughout the year to avoid getting a large tax bill at the end of the year. Payroll taxes are taxes that are paid by both employers and employees. So specifically, these fund the Social Security program and part of the Medicare program, which we'll talk about a little later on. So these taxes are referred to as FICA, F-I-C-A, on your pay stub, which stands for Federal Insurance Contributions Act, which was the law that authorized the payroll tax for Social Security and Medicare. And again, for folks who are self-employed, they have to pay the full amount, so both the employer and the employee shares of their payroll taxes. Some other taxes we just want to mention, we're not going to spend much time on any of these here. We have sales tax, which is a tax on a retail product based on a set percentage of the retail price. So you will pay this tax whenever you buy something. State and local governments generally use sales tax along with income and property tax to pay for state and local public programs. Property tax are taxes paid on property such as real estate, boats, automobiles, recreational vehicles, and also varies based on your state and locality. Estate tax is the tax on the value of a property someone owns at their death, only when an estate is worth more than a certain amount. So, for most of us, I think an estate tax is not something we'll have to deal with. But if you have an estate that has a very high amount of worth, then you will have to pay for this estate tax if you would like inherit somebody's estate after their passing. So only a few individuals actually pay this tax after applying any exemptions and other forms of tax credits. And a tariff is another kind of tax. It is a tax on products imported from foreign countries. So tariffs increase the costs of products that are taxed, which ultimately can be passed on to the consumers as higher prices. All right, so progressive or regressive taxes. This is just a little difference that I think is helpful to understand when we're looking at different kinds of taxes. So a progressive tax takes a larger percentage of income from high income groups than from low income groups and is based on the concept of the ability to pay. A progressive tax system might, for example, tax low income taxpayers at 10%, middle income taxpayers at 15%, and high income taxpayers at 30%. The federal income tax is a progressive tax system. With regressive tax, everybody pays the same amount or percentage, such as with sales tax. So that may make it seem more equitable, but this causes lower income people to pay a larger share of their income than wealthier people pay. So next we're going to talk about what tax money is used for. Federal government uses tax dollars to pay for a lot of different things. For example, national defense, education, healthcare for the poor, unemployment compensation, benefits such as food stamps and housing, subsidies, medical research, transportation, natural resource protection and management, pensions for retired military personnel and government workers, and many other federal important national expenses. So the federal payroll taxes we mentioned before, the Social Security and Medicare taxes, are among the largest programs that receive support from the federal government. So these mainly come from those payroll taxes we discussed earlier. So Social Security provides benefits for retired workers, people with disabilities, and the dependents of both people who are retired and people with disabilities. And Medicare provides medical benefits for people who are 65 or older, certain younger people with disabilities, and people with permanent kidney failure requiring dialysis or transplant. For the state and local taxes, states use taxes to provide services such as the police force, road and bridge construction and maintenance, social programs for the poor and elderly, and support for local public school districts. The taxes vary depending on the state. Most states do have income tax, but some don't. Many states have sales tax and some have property tax. State property taxes are collected on items such as cars and boats. Some states don't require certain individuals to pay income taxes or sales tax. Local taxes are pretty similar to the state taxes. So this is when you're taxed by your county or your city, town, borough, whatever municipality you live in, and are used to provide services like police and fire protection, road and bridge construction and maintenance, social programs for the poor and elderly. Local taxes are also the primary source of funds for public schools. So the taxes will vary depending on the local government, and a few local governments have an income tax. Many use sales tax, and some use property taxes. Local property taxes are collected on items such as houses and condominiums, things like that. So next we'll get into filing taxes and a little more about that. So, why you might owe taxes or get a refund. So, each tax season from January to April, you report all of your income from the previous year to the government and determine how much you owe in taxes. Throughout the year, your employer withholds a portion of your earnings to cover these tax obligations. When you file your tax return, you'll find out if you've paid enough already or due a refund for overpaying or if you still owe additional taxes. So why file a tax return? Well, if you work, you probably have to. People who work for an employer or work for themselves likely have to file a tax return. All wages, salaries, bonuses, commissions, and tips are taxable, even if they are not reported on a Form W-2 from an employer. So, for example, if you receive cash tips at your job. If you don't file, you may even lose out on a tax refund. So, even if you think that you would break even when you filed and you don't think you would owe anything, you never know if you might have a refund coming to you. And when to file, taxes are due on April 15th every year or the next business day if that falls on a weekend. And that is true for the state and local taxes as well as the federal. So next we're going to take a look at some common tax forms. The W-2, employees receive a W-2 from their employers. Employers report what taxes they withheld from the employee's income. Employees use this information to complete their individual tax returns. And then a 1099 is kind of a category of tax forms. There are many different 1099s you might receive based on how you received income. So self-employed workers don't receive a W-2, but if you're a contractor who has completed work for a company, you'll receive a 1099 NEC and you'll report your income using that form. If you have any investment income like interest or dividends, that information will come on a 1099 INT for interest or a 1099 DIV for dividends. And these will also be used to complete your tax return. And the 1040 is the form you submit to the government to report all of your income and tax information. If you file using a website like TurboTax or MyFreeTaxes, they transmit a completed 1040 to the government based on the information you provided. And like Katie mentioned earlier, we also have our free tax prep site here in Turtle Creek. And if you come here, you will give us all of your income and tax information, and we fill it out using our system. And the 1040 is the form that is then transmitted to the government from our side on your behalf. So I have a couple pictures of these tax forms just to kind of point some things out to everyone. So this is the W-2, and you can see, I know it's a little small, unless you make your screen larger, I guess. You can see box 1 at the top is where they will report the wages, tips, and other compensation that you've made. Box 2 has the federal income tax that your employer withheld. 3 and 5 are those Social Security and Medicare wages and tips. Sometimes these are similar to or the same as the wages in box 1. Sometimes they can be a little different if you have a deduction from your paycheck for like a retirement fund. And then boxes 4 and 6 show the tax that is withheld from those wages for specifically the Social Security and Medicare or those FICA taxes. There's also a spot for tips, Social Security tips and allocated tips. And boxes 12A through 12D often have information about retirement and other deductions that come out of your paycheck. And box 14 will also have space for things like unemployment deductions that we all pay into. If you pay union dues, there are a few different things that can fall into that category. And across the bottom, we have where they will report what state your employer is in, and then also kind of repeat that number of the wages you've made and then how much state income tax has been withheld. And then same thing for the locals. It will say how much you made and how much local tax has been withheld. So all of this you would enter into whatever tax filing software you're using or write out on the 1040 to make sure that they have all of the information to know how much has already been withheld from your income. Next, we included some examples of the 1099s that we talked about. So this one on our top left is the NEC or the non-employee compensation. So if you are self-employed and you are completing work for a different company, they will include here in box 1 how much they paid you for that work that you've done for them. Often there will be no federal income tax withheld. If there is, that'll appear in box 4, which is bolded here on the screen. And same with the state and local taxes. If something is withheld, which is very unlikely for a 1099 NEC, it would be reported there, but that is usually up to the person who is self-employed to pay those taxes. And then in the bottom right corner, we have a 1099 INT, so for interest income. If you have a bank account or a savings account where you have a lot of money sitting and you get, a couple dollars of interest or maybe more every year, this will be reported there. Box one will have the total amount of interest income. There's a spot for them to mark what has been withheld. Usually, I believe most financial institutions will withhold that federal tax. So that will be reported in box four. And there are a couple other boxes based on specific interest situations that might be filled in. So that information would all go onto your 1040 as well as part of your income. And then we have the 1040. So I only included the top half of this form because it's a lot of lines and a lot of words that I don't think we need to get that far into. But this is what your tax return actually looks like. So it includes all of your personal information, your spouse's if you're filing joint, your social security number, address, all that good stuff. Filing status, which we'll talk about a little more, any dependents you have, what kind of deduction you're taking, which we'll also get to. And then you'll start filling in information about your income, any withholding that has been withheld from your paycheck, and any tax credits you're eligible for, and any additional information. It will all be put onto this 1040, which can sometimes be a few pages, depending on how much information you have and different attachments. And this is what gets transmitted to the IRS. So next we're going to talk about filing status. So for your filing status, this can affect whether or not you need to file taxes, how much tax you owe to the government, what tax credits you might be eligible for, your standard deduction amount, and whether or not you get a refund. So for an example of what kind of difference there would be there, if you choose to file married filing separately, you are required to file a tax return if you have at least $5 in income. But if you're married filing joint, you can earn up to $29,200 this year before being required to file. So we'll look a little more in depth at each of these filing statuses. So you can file a single if you are unmarried, if you are divorced. This is legally separated. In Pennsylvania, there is no such thing as legal separation. You are either divorced or you're married. In some states, that is a little different, but for Pennsylvania, we're looking for that either divorced or never been married. You can also be considered single if you are widowed after a few years. We'll talk about that in a few bullet points here. There's also married filing joint. So if you're married or if your spouse passed away during the tax year you're filing for, so for example, this filing season, if your spouse passed away in 2024, you would still be married filing jointly. Married filing separate. If you're married and you don't want to file jointly or find that filing separately lowers your tax, most couples save money by filing jointly. So sometimes there are reasons where married filing separate would be beneficial, but they are pretty rare, not very common. Most folks who are doing the married filing separately are people who maybe have been separated, but because there is not that legal separation in PA, they go ahead with that married filing separately. But it usually is beneficial to both people involved to do married filing jointly if you can. Head of household. If you are single and you paid more than half of your living expenses for yourself and for a qualifying dependent, then you can file as head of household, which is a pretty advantageous tax filing status compared to just filing as single, for example. And qualifying surviving spouse, if your spouse died during the past 2 years and you have a dependent child, this status is very similar to the head of household and can be pretty advantageous for someone who has lost a spouse in recent years for their tax filing. So next we're going to talk about deductions. So a deduction reduces the amount of a taxpayer's income that is subject to tax. So everybody is entitled to take one of these two deductions, either standard or itemized. So the standard deduction is a specific dollar amount that reduces the amount of taxable income, and it changes for people who are 65 or older and or blind, or if another taxpayer can claim them as a dependent. Some taxpayers are not entitled to the standard deduction and must itemize. Others use the itemized deduction because their allowed deductions total is greater than their standard deduction. I feel like this seems a little confusing to explain, and it is a hard one to kind of grasp, but 9 times out of 10, maybe more, you're going to take the standard deduction. So this is going to decrease your income by a certain amount. The itemized deduction, I believe in a couple slides, we'll go over all the things that you can itemize. So generally, if you're not obligated to itemize, you'll take the standard deduction unless your expenses are more than what that standard deduction amount is. So I think we have on the next slide the graph of what all the standard deductions are this year. So if you're married filing joint or you're qualifying surviving spouse, the standard deduction is 29,200, head of household 21,900, and single or married filing separately 14,600. And then you can see for taxpayers who are 65 and older or are blind, there is an additional amount that's added to that standard deduction. And for dependents, the standard deduction amount for an individual who is claimed as a dependent by another taxpayer cannot exceed the greater of either $1,300 or the sum of $450 plus the individual's earned income. So it gets a little more confusing with dependents, but if you're filing, for example, single, then that standard deduction is going to take $14,600 off of your income before the tax is calculated. So if we move to the next slide, we can see for the itemized deduction, there are a few expenses here at the bottom. I'll come back to the top. But the expenses that you can deduct if you itemize, so if you have a lot of expenses that fall into these categories that get you above that standard deduction, then you're going to want to itemize because it'll reduce your income even more. So the expenses that you can deduct, any bad debts that you have, canceled debt on a home, any capital losses, donations to charity, gains from the sale of your home, gambling losses, home mortgage interest, income, sales, real estate, and personal property taxes, losses from disaster and theft, medical and dental expenses over 7.5 of your adjusted gross income. So if you have a lot of those expenses, then it will benefit you to do an itemized deduction. But especially at our free tax prep site, but I think in general, most people are going to go with the standard deduction. It's much easier to do your taxes, and most people don't have enough of these specific expenses to get up to that level. Now, there are a few people who have to itemize. So if you are married filing separate and your spouse is itemizing their return, then you also have to itemize your return. If you're filing a return for a short tax year due to a change in the annual accounting period, this is very rare, probably not something you'll run into. If you're considered to be a non-resident alien or dual status alien during the year, and if you are filing as an estate or trust, a common trust fund, or a partnership, then those are the situations in which you have to itemize.
We're going to talk about how to adjust the withholding from your paychecks, which is looking at filing what is called a Form W-4. So to get us started, would you rather have a $3,000 refund, or would you rather have an extra $250 every month in your budget? This is very much going to be a personal preference thing. Some folks really like to get that big refund check from the IRS. Other folks would rather have their money every month during the year when they need to be spending money. So you'll have to think about what matters to you most, what you care about most, or what is going to have the biggest impact on your finances going forward. So by adjusting your withholding, essentially, you can increase or decrease your refund and therefore increase or decrease the amount of money in your monthly paychecks. This Form W-4 is how we adjust our withholding. This changed a couple years ago. There used to be things like people used to say, I have 3 exemptions. That doesn't exist anymore. So if the last time you had a W-4, you remember listing a number of exemptions, you may want to talk with your employer about filing a updated one just to make sure it is the correct updated information. But obviously there would be contact information at the top that you fill out. And then most people are going to do step 1, part C, which is just list what your filing status is. So we talked about what a few of those were. Annie went through them. If you are single and you've got one job, all you have to do is mark single at that top box and you're done with your W-4. You would turn it into your employer. But there are some instances when maybe you want to be filling out more of that. So we're going to look at how we do this. So first we listed our filing status, and then we come down to step 2. This is for people who have multiple jobs, if you work 2 or 3 jobs, or if you are married, you're filing with your spouse and your spouse is also working. So if you and your spouse are working and you both have very similar jobs, let's say you both make about $40,000, all you would do is mark this box on 2C, and then again, you're basically done. When you and your spouse turn those into your employers, their payroll systems are going to be doing the math in the background to figure out how much to be withholding. If you have a very different income from your spouse, there is going to be a different step that we're going to look at next. Or if you have 2 or more jobs, again, you want to look at the next step that comes after this. So for folks who have multiple jobs, this is what you see as you continue to read the form. And you're looking in this little area here that says, if you have 2 or more jobs or you're married filing jointly and you and your spouse have different paying things, there is a chart that we have to look at, find a number, and then come back here to put that number on this line. This is an example of what this chart looks like. So we're going to have a little example for ourselves. We're going to say that we're married filing jointly and that we are the higher paying job. We make $45,000 every year, and our spouse has the lower paying job and they make $35,000 every year. So this is the married filing jointly chart. Qualifying surviving spouse also gets to use it. You'll see that title at the top. And what you do is, since we've decided we have the higher paying job at 45,000, my arrows are in the wrong order, but that's fine. Okay, so our spouse had the 35,000, so we would look in that column going up and down, and then we are in the higher paying job, we make 45,000. So we're looking in this column and row, and then we're going to look across and down and see where they intersect. And we see that they intersect at this $3,610. So this is the number that we have to take back to the other part of the form and write it on the line. So we come back to what that step 2B was, and we write $3,610. Now, if it's just you and you've got 2 jobs, there's also a chart to use where you would compare your higher paying job and your lower paying job. You would see where they intersect and again, write the number here. And then the next step for it, you need to enter the number of pay periods per year for the highest paying job. So in our example, since we're the higher paying job, we're going to say that we get paid every 2 weeks. If you get paid every 2 weeks, it is 26 pays in a year. So you would list 26 here. And then the next step is to divide that number that we found, the $3,610, divide it by our number of pay periods, and it will give us an answer that should be 138.85. There's a little bit of rounding there. So that's all you do for those steps there. And then following the instructions, you're going to take this 138.85 back to another part of the form, because of course IRS forms have to be confusing, having you jump around for a bunch of things. So we're going back to step 4C, and we're bringing that 138.85 with us. That is what we've done here. On 4C, it says extra withholding. You're gonna, as a higher paying person, have an extra 138.85 withheld, but that will make sure that you pay the correct amount of tax throughout the year. And so you don't owe a ton of money to the government later. And then again, of course, because IRS forms go out of order, that was step 4. And now we're going to go back up to look at step 3. But this is an optional section that you can use if you feel comfortable with it, but you could skip it also if you want to. So this starts getting into some of the tax credits that you might be able to claim. So if you have a kid that qualifies for the child tax credit, or potentially someone who qualifies for the credit for other dependents. So that's usually child tax credit, they have to be under age 17. So maybe the credit for other dependents, you have a child who is 20 and still in college, so you can still claim them as a dependent, but you only get $500 for that instead of the $2,000. So if you list a number here, basically what it's going to do is, instead of you getting $2,000 as part of your refund when you file your tax return, they will just be withholding less tax from you throughout the year instead. We're going to pretend that we've got a kid and they're 6 years old, so they're under the age 17, and so we could list $2,000 here. And then if you had multiple kids, you would do some math and multiply that. Or if you had a kid under 17 and a kid who was over 17, that they were the other dependent, you could list the 500 and add them together. You can also use this last line to add other types of tax credits if you're definitely sure you know what your amount is going to be. And this is where I would maybe like child tax and other dependent credit, that is very straightforward what the amounts are. Some other credits are a little harder to figure out because they're not always a one-to-one thing. Like the savers credit, which gives you credit for contributing to your retirement account. You may contribute $500, but you don't get $500 off of your taxes then. So you wouldn't want to list the wrong amount here and have the wrong withholding. So if you're definitely sure what you're going to get from a credit and you feel comfortable listing it here, by all means, it's your tax information, go right ahead. But if you just want to stick with the more obvious ones of the child tax credit and credit for other dependents, that is totally fine. So going back to look at step 4, some other things that you could do. If you have other income every year and it's pretty consistent and you're able to guess what that amount of money is, you could use 4A to list that. So an example of this would be if you have bank account interest and you've got a high yield savings account that's maybe paying you $500 in interest every year, that $500 is taxable income that you have to list on your tax return. But if you want your W-2 job to help pay the amount of tax that you would owe for that $500, you could do it by listing it here. So you could list 500 on this line 4A. This is not for any income from other jobs or like if you're self-employed. So it even says there, this may include interest, dividends, or retirement income. So you could list your other amounts of income here. And again, when you turn it into your employer, they're going to do some math in the background to figure out how much they need to be withholding from you for that. So in our example here, we've got $500 in interest, so we've listed 500 here. If you have a retirement account that you are not at retirement age and you tend to pull money out of it every year, that's a thing that is also a tax situation where you owe a tax on the income and also a fee for having pulled out an early distribution. So it would be really smart to list that money here that you're planning on taking that year to help pay, since you're kind of getting hit twice on that. Also, like, make sure you're being careful about what we're pulling out of our retirement account. You know, if it's an emergency, that's one thing. If we're pulling our retirement money to pay for vacation, maybe not the smartest move because we're not only paying tax on it, we're also paying a fee. But you could list early distribution amounts here as well. And then the other option that you have on this form is going back down to 4C, extra withholding. If you have a similar tax situation from year to year, your income is about the same, you do the same sorts of things, and you know that when you did your 2023 taxes, you owed $1,200 and you don't want to have to pay $1,200 every year, what you could do is ask for extra withholding with a specific amount of money, and then your employer would withhold the normal amount based on your filing status plus an extra amount each pay period. So for this example, let's say we were comfortable having them withhold an extra $25. So they would take out the normal amount of withholding plus an extra 25. All of that still appears on our W-2 at the end of the year, but that extra 25 every pay helps pay that $1,200 maybe that you owe every year. Like if you would go today to your employer and give them a new W-4, what it's going to do is it's going to change your withholding from today going forward. So it can't impact the basically 2 months of pay that you got in January and February already, but for the last 10 months of the year, it will adjust for that. So this is kind of a good time to think about what is your withholding and do you think it's correct? Because fixing it for 10 months is better than fixing it for none of the months, or maybe waiting until the fall when you don't have as much of a time to regain if you think you're going to owe extra money. And then it will continue in all the years to come until you give them a new W-4. So if you submit a W-4 for this year because you know you're going to have some interesting tax situations, but you don't think you'll have that in 2026, then in January of next year, get in touch with your HR people again and say, hello, I would like to submit a new W-4. They have to let you do this each time because it's your tax information. Now, that was a lot. And if you're very confused and you're like, this seems like a lot of information that I have never known before and I don't want to have to deal with it, that's fine. You don't have to have extra withholding. You don't have to make that decision to list your $2,000 for the child tax credit. If all you are comfortable with is listing your current filing status, that is a great move to start with, especially if you have had changes in your household and you haven't submitted one recently. So if you previously were listed as single, but now you got married last year, you want to at least submit a new one that says, hello, I am married, filing jointly, and maybe touch base with your spouse about who is the higher paying person, maybe. But if you at least can list that you're married, it's going to be withholding a correct amount. Or maybe you previously were a head of household because you had a child that you were claiming, but your kid has grown up and they now file their own taxes and you don't claim them as a dependent. You are going to want to at least submit a form that says, I'm no longer head of household anymore. Maybe I'm single, so that they're withholding the right amount because you just don't want to have a giant tax bill. And as I stated at the beginning, all of this is just to, you'll have to think about, do you like getting a really big refund each tax season? Or would you rather have more of your money every month in your pay so that you can have it for your monthly budget? There's not necessarily a right or wrong answer. It's going to be what works best for your situation and your household finances. If you are loving getting a giant refund and you don't want to change that, like, that's fine. That's you. It's your tax money. You can make that choice. But if you don't want to basically be giving the federal government an interest-free loan of your money until you get it back at tax time, this is a way to correct it. There is also on the IRS website a tool called the tax withholding estimator. So if you don't want to figure things out on paper by yourself, and we'll include this link in our follow-up email if you want to check it out for yourself. But it will ask you questions like you'll see it here. It's asking, what is your filing status for your tax return? It'll ask about different types of income that you have and any adjustments or credits you think you might get. And then on page 6, the results, it will basically tell you how to fill out your W-4. So if you want to click some buttons and have someone kind of give you the answer, this is a great way to do it. It's built by the IRS, so you know it is going to give you the right answer there. And then after all of this, how do you file your tax returns? So as Annie stated earlier, we have a VITA site here at the Human Services Center, Mon Valley. We would love to help you file your tax returns. VITA sites are certified by the IRS. All of our staff and volunteers did a lot of training and multiple certification tests to prove that we know what we're doing. So we would love to have you come visit us. We can help you file the 3 tax returns you need to do every year: federal, state, and local tax returns. To get an appointment with us, you would call 211, which is United Way's helpline. So call them, or you can visit this website, pa211.org/VITA. That will just allow you to sign up for an appointment online. That does not mean your actual tax appointment will be virtual. It's just, it lets you sign up online. And the income limit for this is $45,000 for your 2024 total income if you were the only person listed on your tax return, if you're an individual. If you are a family or household, whether that is you claiming any number of dependents or you file with your spouse, that total household income can be up to $65,000. If you feel confident and want to do your taxes online yourself, you're welcome to do that. There's 2 options. This middle green line says My Free Taxes. This is a website that is run in partnership with United Way. So it is definitely free the whole way through your federal and state return. It is not going to suddenly charge you to do one of those like TurboTax sometimes does or H&R Block. Totally free. It will let you file the federal and state returns. If you have a W-2 job or any self-employment income, you will still need to do your local tax return on your own. But you can do your taxes with My Free Taxes at myfreetaxes.com. The income limit for that is $84,000. The system is set up that some of the calculations don't work if you earn more than that, which is why it has that income limit. And then for Pennsylvania, we can now use the IRS direct file program. So this is a website the IRS put together so you can file directly to them, not having to go to all of these different places. It also only lets you file federal and state, so you would still need to take extra steps to file your local tax return if you have earned income. It's a really long link to get to, so I've put a bit.ly here. And again, you'll have access to these links in our follow-up email, but that will take you directly to the IRS site. You'll answer some eligibility questions to make sure that you can use the site. They don't do all tax forms on there, which is interesting to me, but it looks like in the middle of this season, they'll be expanding some of what they can accept. And the income limit on this is a little weird. It's based on filing status, but also based on how many jobs people have. So if you are married filing separately, you can only make up to 125,000. If you are single with more than one job, you can only make up to 168,000. But if you have one job, you can have up to like 200,000. So that's where it gets a little weird with their income limits. And then married filing jointly, 200,000 for that as well. So probably all of us would fall into those categories, but if not, you'll have to find another place to go for these taxes then. So those are 3 ways that you can get your taxes filed totally for free, not having to pay anyone for them. We really would love to see you at our Bite site though, so feel free to visit us. We also have some partners throughout Southwestern Pennsylvania that operate on different days than we do, or if you're like in the North Hills and don't want to drive to Turtle Creek to see us, there are places in the North Hills you can go to. Okay, so our sources for where we got all this information, 2 great partners that we work with, the Consumer Financial Protection Bureau. It's a government agency that is out there to protect your finances from corporations and big agencies that don't always treat us great as little individuals. And then also, of course, the Internal Revenue Service, which is the go-to place for all questions about taxes because that's what they run. So at this point, I'm going to stop my screen share and then see if any of you have questions for us.
There were a few questions for people that people submitted on the registration form. So some of them are just some quick questions I thought we could cover for both of you in case this applies or for anyone who's listening to the recording. So someone asked, do senior citizens pay taxes on income? Senior citizens pay taxes on income if they have like a W-2, like a regular job that paid them. The retirement and Social Security that senior citizens gets a little more complicated. It depends on if they're taking it after a certain age and on what their total income is. So like if your income from retirement and Social Security is over a certain amount, then some of your Social Security becomes taxable. So it gets a little bit confusing with those things. But if we're talking earned income, like working a job, then yes, they definitely do.
I'm just going to add that usually Social Security and retirement are not taxable to the state of Pennsylvania. So if you're a senior, you might have a requirement to file a federal tax return, but you may not have a requirement to file a state tax return. So that's also where it gets a little confusing for folks.
Someone else asked what changes are for 2025, and really the simple answer is there have not been many changes from the previous year. Usually the first webinar we do every year is about what tax law changes there were, but there were none. So that's why we did this Taxes 101 instead. So not a lot to update there. One last question we have here, somebody asked, I think I kind of covered this already, the married filing joint versus separately, which is better for the first time after getting married to file as. For almost everybody, it's going to be married filing jointly. That's the short answer. It gets a little more complicated in some situations, but if you're like each working a job and there is no like extenuating circumstances, then married filing jointly is going to be your best bet.
And that's usually because married filing separately doesn't qualify for a lot of tax credits. So we'd rather you get tax credits, and that's why we suggest filing jointly. But we're always happy to talk through people's tax situations to figure out which one would be best for you.